The past few days have felt like an economic whirlwind, haven't they?
Absolutely.
From these startling shifts in the jobs market to, well, a flurry of new tariffs and corporate upheavals, it can feel like trying to drink from a fire hose.
It's a lot to track.
But that's exactly why we're here. Our deep dive today is all about untangling these threads, extracting the most important nuggets of knowledge and helping you understand the real implications behind the headlines. Think of it as your shortcut to being truly well-informed without feeling completely overwhelmed.
And to guide us through today's complex landscape, we've gathered quite a stack of fresh reports and analyses from CNN Business, CNBC, and Fox Business.
Okay, let's kick things off with that July jobs report. It wasn't just muted expectations, was it?
No, not at all.
It delivered a genuinely shocking number, I thought. Non-farm payrolls only rising by 73,000 for the month. That feels like a significant jolt.
It really does. And what's truly striking here isn't just the weak July figure itself. It's also the heavy downward revisions to the May and June count.
Yeah.
This dragged the 3-month average job gains down to a mere 35,000.
35,000, wow.
Yeah. I mean, to put that in perspective, that's less than 1/3 the pace from just a year ago. And it actually represents the weakest job growth since 2009, if you exclude the pandemic recession.
Since 2009.
Exactly. So the collective alarm from economists, it suggests we're witnessing a real deceleration in the U.S. economic engine, perhaps more rapid than many anticipated.
And on top of that, the unemployment rate also ticked up slightly to 4.2% from 4.1%. So how are leading economists reacting to this combined picture?
Well, zooming out, many are indeed sounding major alarm bells. You have Josh Bivens, chief economist at the Economic Policy Institute, who flatly stated this report is what entering a recession looks like.
Pretty stark language.
Very. And Mark Zandi, chief economist at Moody's Analytics, he posted on X that the economy is on the precipice of recession. Even Goldman Sachs, typically a bit more conservative, forecasts U.S. growth to be just 1% in the final 2 quarters of the year.
Only 1%.
And they're partly attributing this to slower consumer spending. So what these collective warnings suggest isn't just a concern for recession, it's maybe a growing consensus that the Fed's strategy has, perhaps, finally delivered the slowdown they aimed for,
Right.
but with potentially steeper consequences than maybe they anticipated just weeks ago.
That's a really stark picture, and the timing for the Federal Reserve is critical here, isn't it?
Oh, absolutely critical.
They had just held interest rates steady days before this report dropped. Chair Powell was saying the labor market was solid. How does this data complicate that narrative?
Well, it creates a significant challenge for the Fed's credibility, frankly. Their decision to hold borrowing costs steady came just 2 days before this, well, sobering jobs report landed.
Right.
And critics like Jamie Cox, managing partner at Harris Financial Group, they were quick to comment that Powell is going to regret holding rates steady this week. It definitely puts the Fed in a difficult, almost reactionary position.
And it sounds like there was already significant internal disagreement within the Fed about holding rates steady even before this jobs report.
There was, yeah. And the pushback was remarkable, really unlike anything seen in decades. You had Fed Governor Christopher Waller and Vice Chair for Supervision Michelle Bowman both casting dissenting votes.
2 dissents, that's rare.
Very rare. It's the first time more than one Fed governor has dissented since 1993. And their key reasons: increasing signs of fragility and a less dynamic labor market. They also downplayed the potential effects of tariffs on prices.
Interesting.
So it suggests a deeper division within the Fed itself, highlighting the uncertainty in their own economic outlook.
So how are the markets, which are usually a pretty good barometer, reacting to all this swirling uncertainty?
Predictably volatile. Markets have been, quite jumpy. Just before the jobs report, traders assigned pretty low odds to a rate cut at the central bank's September meeting.
Okay.
But then on Monday, that swung dramatically. They're now pricing in a nearly 90% probability of a cut in September.
90%, that's a huge swing.
It is. And this rapid shift isn't just about high uncertainty. It signals perhaps a potential loss of confidence among traders in the Fed's immediate foresight.
In their ability to manage the economy's immediate trajectory, maybe.
Exactly. That's a good way to put it.
That market volatility is certainly something to watch. But, okay, beyond these immediate economic jitters, there's this more structural shift unfolding, the administration's aggressive trade policies.
Yeah.
I'm keen to understand how these sweeping tariffs are truly playing out. both here and, internationally.
Yeah, it's a huge factor. I mean, the U.S. collected over $29 billion in tariff revenues in July alone.
29 billion.
In 1 month.
In July, yes, a new monthly record. And it pushed the year's total to more than $152 billion. And new tariff rates ranging from 10% up to 41% on goods from over 60 countries. Well, they're set to begin being collected on some shipments starting August 7th.
Now, the administration often frames these tariffs as being paid by other countries, but is that really the case? Or is the cost absorbed closer to home? Well, while it's true the importers write the check to the federal government, the reality is that the cost very often falls directly on you, the U.S. consumer.
How so?
Because companies raise prices to offset that economic burden. And the truly illuminating point here isn't just that consumers pay, but how disproportionately this can impact lower-income households.
Ah, right.
Economists from UCLA and Yale highlighted this. It effectively turns a trade policy into something like a regressive tax.
That's a critical point.
Right.
What are some specific goods where we could see these price increases directly impacting our wallets?
Well, according to economists at the Yale Budget Lab, if these tariffs stay in place indefinitely, prices could rise pretty significantly across a range of goods. For example, computers and other electronics, they could increase by about 18.2% in the short run.
18%.
And clothing prices by a staggering 37.5%.
37.5% for clothing. Wow, that's huge.
It is. And we could also see higher prices for things like watches, shoes, alcohol, furniture, and toys.
So pretty broad impact. How are other major trading partners reacting to these new tariff threats?
Well, the European Union just announced on Monday that it will suspend its planned countermeasures against the U.S. tariffs for 6 months.
Okay, a suspension. Why?
It follows a trade deal framework agreed upon in late July between President Trump and European Commission President Ursula von der Leyen. That included a 15% tariff on most European goods, like cars, and the EU agreeing to buy about $750 billion worth of U.S. energy.
$750 billion.
But, and this is important, the EU also stressed that this was a political agreement, not legally binding.
Ah, so not set in stone.
Exactly. It raises questions about how those ambitious investment and energy purchase goals would actually be met by private companies,
Right, that makes sense. And what about India? It sounds like they're facing even higher tariffs.
Yes, President Trump stated he would substantially raise tariffs on India. He claims they continue to buy massive amounts of Russian oil and then sell it on the open market for profit.
And India's response?
Well, India pushed back, arguing its oil imports are a necessity for its consumers. And they also pointed out that the U.S. and EU are also, quote, indulging in trade with Russia, making the targeting feel unjustified to them.
Okay. There's also been a suspension of something called the de minimis exemption. What exactly is that, and what's the impact of suspending it?
Right, the de minimis exemption. It was essentially a global trade loophole. It allowed shipments worth $800 or less to enter the U.S. duty-free.
$800, okay.
And it was heavily used by these Chinese mega shippers like Shein and Temu. U.S. Customs processed nearly 4 million such shipments a day last fiscal year.
4 million a day, mostly from China.
Most of them from China and Hong Kong, yes. And Trump's latest executive order extends the suspension of this exemption to every country, not just China.
So what does this all mean for consumers and for companies like Temu and Shein, which have really blown up in popularity?
It effectively closes a major loophole, a huge one. Companies will now have to pay hefty import taxes, even if they ship things in bulk, parcel by parcel.
And that cost.
As we discussed, that cost could very well be passed down to you, the consumer. And research from UCLA and Yale economists back in February indicated that lower-income households would likely suffer the most from higher prices on these sites.
Because they were using them more.
Exactly. About 48% of these de minimis packages were shipped to America's poorest zip codes. So it's a significant financial squeeze for a particularly vulnerable segment of the population.
Yeah, all these tariffs are partly aimed at encouraging more made-in-USA production, right?
That's the stated goal, certainly.
But the history here is complex. What lessons can we learn from past attempts like, say, Motorola's effort a decade ago to build smartphones in the U.S.?
Yeah, that Motorola example is really instructive. Their effort with the flagship Moto X phone was a significant attempt to build smartphones domestically.
I remember that. What happened?
Well, despite the consumer appeal of a made-in-the-USA product and enabling greater customization, which was cool, Motorola ultimately shut down its Texas factory in 2014. They abandoned domestic assembly.
Why? Was it just costs?
The challenges weren't just about higher costs or even proximity to suppliers, though those were factors. Crucially, it was the difficulty in finding and retaining skilled workers.
Skilled workers for assembly.
Yes. Dennis Woodside, Motorola's former CEO, described the assembly work as being like a super tiny Lego set. It required really high dexterity, and he said most U.S. workers just weren't accustomed to that kind of fine motor skill work on a mass scale.
So it wasn't just about wanting the jobs back.
Right. The real insight from Motorola's experiment, I think, is that tariffs alone won't just conjure a workforce for complex manufacturing. You need a national strategy for developing that kind of dexterous and specialized labor, especially when countries like China have booming manufacturing sectors and, frankly, deeply planned approaches to workforce development.
And how does this historical context apply to current efforts? We hear about bringing manufacturing back, especially in critical sectors like pharmaceuticals.
We see this challenge playing out right now, in the pharmaceutical industry. You have drug makers like AstraZeneca, Johnson & Johnson, Eli Lilly. They're announcing over $250 billion in planned investments to expand U.S. manufacturing.
That's a huge number, partly due to tariffs.
Partly in response to Trump's tariff threats, yes. However, for generic drugs, it's a different story. Generics account for over 90% of U.S. prescriptions, right? Critical for national security.
Definitely.
But it's much harder to shift that production because of their thinner profit margins. Experts say you'd need significant incentives beyond just tariffs, or, ironically, tariffs could lead generic drug makers to pull out of the U.S. market entirely.
Worsening shortages.
Exactly, worsening existing shortages. So it really highlights the nuanced reality that tariffs are not some kind of one-size-fits-all solution for bringing back production.
Okay, shifting from global trade to major corporate headlines. It's been a week of dramatic shifts for individual companies, too. From Tesla's contentious pay package and legal woes to surprising turns for brands like American Eagle. Corporate strategies are facing intense scrutiny. Let's start with Tesla and Elon Musk. What's the latest on his pay package?
Right. The Tesla board just awarded Elon Musk a new $29 billion interim pay package.
$29 billion. Interim.
Yes, in shares to retain him at the helm. This comes while his original $56 billion package from 2018 is still tied up in a legal battle. Remember, a Delaware court rejected it, and that ruling is now under appeal.
So this new one is, while that's ongoing.
Correct. Tesla stated that Musk hasn't received meaningful compensation for 8 years.
That's a huge amount of money, though, especially given Tesla's stock has been struggling and he's been so focused on, well, other ventures.
Indeed. Tesla shares are down 25% this year. They just reported weak Q2 earnings with sales falling for a second straight quarter. And Musk's extensive political involvement, including his work with the Trump administration, has been cited by some as a factor in consumer backlash against Tesla, maybe impacting EV sales. So the new pay package keeps him at the helm as the company tries to pivot more towards AI and robotics, like, robotaxis, amidst all these internal and external pressures.
And what about that autopilot crash lawsuit? That feels like another significant hurdle for his autonomous driving ambitions.
It's a major one, potentially. A Florida jury on Friday found Tesla liable in a 2019 fatal crash involving an autopilot-equipped Model S. They ordered the company to pay $329 million to the family of a deceased woman and an injured survivor.
$329 million, that's substantial.
It is. And this is highly significant because it's the first time Tesla has been hit with a judgment in a wrongful death case involving autopilot where a third party was killed, not just the driver or passenger.
I see.
Experts believe this verdict could make future settlements more expensive for Tesla. And it could potentially impede Musk's ambitious autonomous driving plans by raising, frankly, serious questions about the technology's current safety and liability.
Okay. From high-tech legal battles to surprising swings in the fashion world, American Eagle saw a huge stock jump recently. What was behind that?
Yeah, American Eagle Outfitters shares surged over 23% on Monday.
23%. Why?
It happened after President Trump publicly complimented their marketing campaign featuring actress Sydney Sweeney. He called it the hottest ad out there and noted Sweeney is a registered Republican.
Wow. But that campaign itself had already been quite controversial, right, before the endorsement?
Yes, absolutely. The slogan, Sydney Sweeney has great genes, had already drawn significant criticism. Some far-left critics suggested it had a double entendre and was about the actress's genetics and, quote, whiteness. American Eagle responded by saying the slogan is and always was about the genes.
Right.
This whole saga, though, It really highlights the incredibly difficult tightrope marketers are walking in today's politically charged environment.
A bit like the Bud Light controversy.
Exactly, reminiscent of that, where marketing decisions can have swift and dramatic impacts on stock performance, often in really unforeseen ways.
Beyond these individual corporate dramas, what other notable shifts are we seeing in the corporate landscape this week? Layoffs, restructuring.
Yeah, on the restructuring front, Amazon is laying off about 110 employees in its Wondery podcast unit,
Wonder. Okay.
and Wondery CEO Jen Sargent is stepping down. The company is consolidating its narrative podcasting under Audible, and its creator-led content is going into a new creator services unit.
So a big shuffle in their audio strategy.
It's a clear move to restructure its audio business. They said it's in response to the significantly evolved podcast landscape, especially the growing popularity of video podcasts on platforms like YouTube.
Makes sense. And we've seen some interesting IPOs and earnings reports, too.
We have. Figma stock dropped 27% on Monday after its massive post-IPO surge last week, though its valuation is still nearly triple what Adobe had offered to acquire it back in 2022.
It's still way up then.
Still way up, yeah. On the space tech front, Firefly Aerospace lifted its IPO range. It's now valued at over $6 billion, so continued investor interest in that sector. Palantir just topped $1 billion in quarterly revenue for the first time, seeing a boost from the government's efficiency campaign.
Okay.
And Hims & Hers Health, their shares fell after missing revenue expectations. That's amidst ongoing controversy over its sale of cheaper, unapproved, compounded GLP-1 weight loss drugs.
Right, that controversy continues.
Right.
So how do all these individual corporate stories, tech, retail, pharma, how do they fit into the overall market picture this week? Was it all negative?
Actually, stocks did rebound strongly on Monday. The Dow erased Friday's losses. The S&P 500 snapped a 4-day losing streak.
A bounce back then.
Largely seen as a bounce-back day, yeah, after the jitters from the jobs report and the new tariffs. However, analysts are warning that August and September are historically weak months for the market.
So don't get too comfortable.
Exactly. This rebound could be temporary. DoubleLine Capital CEO Jeffrey Gundlach, for instance, still anticipates 2 Fed rate cuts this year. He believes dollar weakness will benefit international markets, so the picture remains incredibly fluid.
Okay, let's transition now to a different kind of headline. One that feels intrinsically connected to the economy, but also touches on something much bigger. The very integrity of information itself. President Trump just fired the Bureau of Labor Statistics Commissioner.
Yeah. What's truly astonishing here is that President Trump claimed, entirely without evidence, that the July jobs numbers were rigged and a scam.
Rigged and scam. Strong words.
Very strong. He publicly accused Commissioner Erica McIntarfer of manipulating them for political purposes and stated he wants his own people there.
But these revisions to jobs numbers, are they unusual? Could they possibly be proof of manipulation, as he suggests?
Well, placing this in broader context, the Bureau of Labor Statistics, the BLS, it's an independently operated, non-partisan body.
Right.
Its initial jobs numbers are always considered preliminary. Always. They're based on incomplete data, and they are regularly revised twice in subsequent months, followed by an annual revision every February. That's standard practice.
So revisions are normal. Were these ones unusually large?
The May and June revisions were historically large, yes, but they were neither unprecedented nor did they suggest any kind of corruption. The BLS is widely regarded as the, quote, finest statistical agency in the entire world.
So given that reputation.
Exactly. What this compels us to ask is, given the BLS's sterling reputation, why are we seeing such aggressive, unsubstantiated attacks on its integrity right now?
That is the crucial question. When a president publicly attacks and fires the head of a statistical agency like that, what message does it send? Not just to the agency, but to the public, to the foundations of economic decision-making.
Well, the message is deeply concerning, frankly. Experts across the political spectrum have weighed in. Former Treasury Secretary Lawrence Summers, even former BLS Commissioner William Beach, who was actually nominated by Trump in his first term.
Oh, really?
Yes. They've called these actions preposterous, groundless, and deeply worrisome. They warn that this kind of rhetoric profoundly undermines trust in critical data that businesses, government, and the Federal Reserve rely on for accurate decision-making.
So it affects everyone.
It does. And adding to this, the BLS is also facing staff layoffs and scope reductions due to cost-cutting. Federal Reserve Chair Jerome Powell has even expressed concern about that, noting a mild degradation of the scope of the surveys.
Hmm.
So the real long-term risk here isn't just a political spat. It's the potential erosion of public trust in objective data, which is absolutely essential for a functioning economy and democracy.
Okay, let's turn to another area where the administration is pushing for change, though with maybe a different kind of narrative.
Mm-hmm.
Public health. They're claiming victories on removing artificial colors from food.
That's right. The Trump administration is indeed touting pledges from major companies like Kraft Heinz, Skittles, General Mills, pledges to remove artificial colors. They're aligning this with their Make America Healthy Again, or MAHA push. Coca-Cola's plan to use U.S. cane sugar in a new version is also being cited as a MAHA success.
On the surface, that sounds positive, doesn't it? Fewer artificial colors. But is it truly making a substantive difference to public health?
Well, nutritionists and public health researchers largely view these as cosmetic changes, more like just PR.
Cosmetic, why?
Because many companies were already moving in this direction anyway due to broader consumer demand for natural ingredients. Some had even backtracked on previous commitments before this push. And what's critical here, critics argue, is that the administration's simultaneous funding cuts for healthcare, food stamps, research, public health programs,
Right.
those cuts fundamentally contradict a genuine commitment to making Americans healthier. The real culprit, many experts say, isn't necessarily artificial colors, but the prevalence of ultra-processed food.
Ultra-processed foods.
Yeah. They constitute up to 70% of the U.S. food supply and are frequently linked to obesity, cancer, diabetes, heart disease. And while HHS Secretary Robert F. Kennedy Jr. has brought attention to this issue, the agency hasn't yet enacted significant measures to actually cut down on ultra-processed foods.
So these color changes, while maybe visible, they kind of miss the larger systemic issues impacting health?
That's the argument from many public health experts, yes.
Okay. Let's shift gears completely now to a more tangible sign of progress and investment, perhaps. A massive infrastructure project taking shape in New York. Tell us about the new terminal at JFK Airport.
Right, the new Terminal 1 at JFK, it's a $9.5 billion project, and it's rapidly taking shape. The first phase is slated to open in mid-2026.
Replacing the current Terminal 1.
Exactly. It will replace the current one, which opened back in 1998. This new one will be JFK's largest terminal, nearly the size of LaGuardia's two new terminals combined, just to give you a sense of scale.
Wow, that's big.
It is. It's designed specifically for international travelers. And it's part of the Port Authority of New York and New Jersey's much larger $19 billion overhaul of JFK. It addresses a national need, too. We need over $173 billion in airport infrastructure upgrades across the country by 2029.
So what are some of the standout features? What will make this new terminal a genuine upgrade for travelers?
Well, it's designed to be flooded with natural light, which should be nice. And importantly, no basement customs lines. That's a significant departure from many older airport designs.
That's good news.
Yeah. The design itself, by Gensler, is said to conjure the image of a butterfly. And crucially, from a practical standpoint, it will have its own microgrid with solar panels on the roof.
A microgrid? For what?
It enables full resiliency and maintenance of 100% of the terminal's operations in the event of power disruptions, so much more reliable. It will also feature a cash-and-carry duty-free shopping experience, which is actually unique for a U.S. airport. Signals a more modern, convenient international travel hub.
Interesting. Okay, finally, let's touch on something that impacts many of us directly. Student loans. What's the latest with the federal SV plan? What do borrowers need to know right now?
Right. Well, after a year-long pause, interest charges on federal student loans enrolled in the Saving on a Valuable Education Plan, the SAVE plan, they resumed on August 1st, 2025.
Interest is back on.
Interest is back on for SAVE participants, and the SAVE plan itself is set to officially end in July 2028. That's largely due to federal court blocks in response to a lawsuit challenging it. Also, new applications for other income-driven repayment plans like ICR and Payee are also ending.
Okay, so for the 7.7 million borrowers currently on the SAVE plan, what should they be doing now? How do they prepare for these changes and, avoid potentially thousands more in compound interest?
Yeah, this is a critical consideration now for you if you're a borrower on SAVE. You should really start making payments or seriously consider switching plans now to avoid accumulating significant compound interest.
What are the options?
Well, experts advise calculating which scenario will lead to the least amount paid over the lifetime of the loan. That's key. Your alternatives include, maybe, Continuing with interest-only payments on SAVE for now, though that's temporary. Switching to an income-based repayment plan, or IBR, that uses your salary to determine payments and offers forgiveness after 20 years. Or refinancing your student loans with a private lender.
Okay, refinancing. What are the key pros and cons there, especially given the current interest rate environment?
Well, the pro is if you're in a good financial position, you have a strong credit score. Private lenders might offer lower rates, maybe as low as 4.30% with a 720 credit score potentially. That compares to federal rates of, say, 6.39% for undergrad or even 8.94% for PLUS loans.
So potentially lower payments. What's the catch?
The major caution, and it's a big one, is that refinancing a federal loan into a private one means you permanently lose access to all federal benefits,
Like,
like hardship protections, income-driven repayment plans like IBR, and perhaps most importantly, any potential future student loan forgiveness programs the government might enact.
so you lose that safety net.
Exactly. It's a trade-off between potentially lower rates now and losing those crucial safety nets down the road. A very personal calculation.
Right. Okay, as we wrap up this deep dive, it's clear we're navigating a truly complex period, defined by economic uncertainty, these powerful shifts in government policy, and some really dynamic corporate responses.
Absolutely. From the, contentious jobs numbers influencing the Fed to the sweeping impact of tariffs on everything from your electronics to your clothes, and even the future of major companies like Tesla. These aren't just isolated headlines, are they?
No, not at all.
They are deeply interconnected, and they're shaping the world around you in sometimes unexpected ways. It really demands a nuanced understanding.
It's a lot to take in, for sure. But understanding these connections is really key to being truly well-informed and, well, to making sense of the forces at play.
It is. And maybe a final thought for you to consider. As we watch these powerful forces at play, from policy decisions shaping our economy to attacks on the very nature of information itself, and even the future of work and skills, consider what these shifts might mean for the balance between government, the market, and individual autonomy in the years to come.